Only a fraction of the personal credit cards, personal loans that are applied for are ever approved by banks across the country. And the numbers are probably even worse on the business side. How do you strategically function and apply for credit lines, credit cards, etc.? Improve your approval odds to the point where you minimize or completely eliminate denials and declines. How do you go about applying for and building your banking relationships in a way where you can minimize or outright eliminate getting declined for applications when you apply? That's what we're going to talk about and cover in this video. And as always, I'm going to give you this perspective with a ton of experience from a borrower's perspective, as well as a banker and a broker's perspective, somebody that takes applications on the personal and business side. I'm going to give you context, as always, in psychology around how to minimize or outright eliminate getting denied for loans and credit cards anytime you're applying for them, regardless of the bank. You have to understand, as I always teach, that you have to be your own underwriter first, and you have to understand the psychology of the bank or the lender that you're applying with. There are so many data metrics that you're measured by when you put in an application, even for the most basic credit cards, even the most basic loans and lines. You're constantly being analyzed on the deepest levels, especially if that financial institution has the technology to do so. Again, this is going to be less applicable at your small banks and credit unions. They don't have the technology and the means at the time of this recording to analyze you in that way. So they're going to be looking at your major metrics when they're analyzing you for applications and loans. Credit score, credit profile, income, basic information that they can take on the application, employment history, etc. When you start to deal with your tier 1, tier 2 banks, that's becoming a popular term, meaning your largest banks and larger super regional institutions, they have the technology and the infrastructure to look at you across dozens of spectrums. Every credit card, every loan that they put out, every line of credit, there's an avatar of who they want to apply for, extend this product to. And many of us that are expanding our personal and business financials don't really think about this. We kind of look at this from how the product can serve us. Very seldomly do we assess who the bank wants to serve with this product. Very, very important factor that we miss out on when we're applying for loans and lines. And it gets us denied a hell of a lot more often than we should be. Banks create products, and they create those products to reach certain avatars, certain audiences. You can be overqualified for a product, underqualified for a product. You can be out of line for a product. The data on the application you're putting down based on that avatar that they had built out when they created that product. If you stick most of the credit cards in this particular case, especially these larger institutions that have dozens of credit cards, they literally create so many products to reach a broader range of audiences. There's starter credit cards. There's credit cards that'll be tailored to those who are in college, new to the country, those who have for retail spending, certain retail spending, high spenders, luxury travelers, certain businesses, the list goes on. Larger national banks and super regional banks typically have upper single to double-digit credit product lines. There's a different avatar. There's a different applicant they're looking for in every single credit card. You don't fit them all. As good as your credit profile might be, as established and as large as your income might be, as great as your banking relationship might be, they don't care. You may not meet the criteria of who they're looking to do business with on that particular product. And this is where it gets very, very, very dicey when you're applying for credit, especially when you're shotgunning applications. When you're throwing out 5, 10, and 15 applications at a time, hoping something sticks. This is, I have these immediate data points that this creator's put out, these application rules this creator's put out, and I'm gonna work right under those lines to put out these applications. And because I have a certain credit metric that I've met, I have a certain number of applications and inquiries that I'm below, I should be fine with these handful of institutions. Absolutely not. That is not gonna be the case. In many cases, there are dozens of other metrics that these banks are gauging you by, and there's also an avatar that they're looking to reach in that given product. You can meet the major qualifying factors and application rules and still not fit a product. And why is this important? Banks are able to analyze what business you're doing with who. I've said this on many videos. I'm going to continue to say it on many videos to come. Banks know, especially your super regional and your national banks know when you're applying for bank accounts and other credit with other institutions, even if it doesn't show as a hard pull or the hard pull is removed from your report. Through various underwriting systems, various data aggregates or aggregators, they are able to tell when you're applying for bank accounts, soft credit pools, and other metrics. They communicate with each other directly. In many cases through software and data aggregators that they own collectively. EWS is a good example of this. Other content creators, a few good ones out there are talking about this already. Early warning system. I work at a financial institution that uses this on a regular basis, so I'm not copycatting anybody. I'm telling you firsthand because I watch people get denied for bank accounts and credit cards. Active accounts get shut down through EWS. I see it firsthand. These systems and AI technologies are owned collectively by institutions. So on top of the fact, these products are created for certain avatars and applicants. You're not paying attention if they even fit for you. You're only looking how it can serve you. You're not looking at an institution who they want to serve, and now you're getting denied. So now you're not only outside of the avatar that the bank's looking to lend to, but you're not credit seeking. You're not doing too much. And these financial institutions are aware of it, and they may not tell you directly or in black and white, plain. They might use some really cute terminology or excessive terminology or vague terminology to tell you that they're not comfortable with the way you're trying to do business. Slow down and apply for credit slowly and strategically. Do not think because you've reached your credit profile to a certain threshold, maybe you've even been fortunate enough to develop a legitimate business that has revenue or business credit, thinking that those high-level metrics are going to cross you across the finish line with every bank you apply for. Stop doing that. It doesn't work that way. Not every single product, just because it has a 0% APR or a major welcome bonus and a certain high-level credit score and profile that's looking for and a set of application rules that you meet, that you're going to get that card. Comment down below if you run into this. It's not always the case. Stop applying for credit so erratically. Study the institutions you're banking with. Learn their appetite for lending, their underwriting and risk tolerance. Learn the avatar for the product they put out. Pay attention to the point structures. Pay attention to the 0% APR periods. Pay attention if they're encouraging balance transfers. Pay attention if they're encouraging certain types of spend. Who that spend might tailor to. Do you fit it? Intermediate to long term. Don't just hit the immediate metrics to get your bonus or that business spend you were trying to get at a 0%. Pay attention to who these banks are trying to reach. And you only can effectively do that by banking strategically. Find 2 to 4 financial institutions every 6 months and build with them. Don't deviate to 10, 12 institutions just because you might have the access capital to do it or you think you have the credit profile to do it. Build with them, learn them, interact with them, study them if you're serious about this. Now, for many of you, this may be a turnoff because you don't want to do that level of work. But I know I got real pioneers on this channel that are serious about the way I'm putting this down and the way I'm providing this information, that understand the value in it, that are willing to do the work and study and learn from people who know the game from both sides of the fence and take this information and become successful long term with these institutions. Because your goal is to get this approved for as much as you can at the best rates and term possible. And you want to learn the way these institutions function, each institution, so you can get access to the best rates and terms long term, because the real wealth is built through managing debt and acquiring assets at the cheapest price with other people's money. That is the real game of wealth in the United States of America in this capitalistic society. If I can go out and acquire real estate and I can pay 2 to 3% less in interest rates because I effectively borrowed that money at the highest level, I am saving hundreds of thousands to millions of dollars in just the financing side of the money. Not just the rent, not just the principal pay down, but the fact that I'm paying 5% over the life of 20 or 30 years versus 7 to 8% or 10%. Because I not only built my business and personal credit, built a solid revenue, built solid employment history, all those other high-level metrics, but I learned to navigate the financial institutions that gave me a shot. And they gave me the best financing long-term on all my businesses and property and my investments. Every real estate deal, every business I acquired, I got the best rates and terms. There's so much money to be made in just not paying so much in interest because you don't look as credible. You look riskier than you had to look. You're saving so much more money. So I want to teach you that, because if you minimize the applications that you get declined on, the banks you get turned away from, the banks you get your relationship shut down on because of your erratic behavior, because you're not fitting who they wanted to lend to, I can assure you your success rate is going to go through the roof. That's a guarantee. Comment down below. Let me know your experience with this. How are you doing your banking and your credit applications so far? Are you pacing yourself and taking your time, and what are the results? Have you been shotgunning? And what I'm dropping right now has turned the light bulb in your head. Let me know the institutions you're banking with, the applications you try for success and failures down in the comment section below. Other than that, to all my pioneers, welcome back. To my new viewers, welcome in. I want each of you to stay focused, stay in motion. I'll see y'all soon.